What if the greatest secret to building wealth isn't about what you do, but what you don't do? We live in a world of financial noise, a constant barrage of gurus on TikTok, screaming headlines about the next big stock, and the paralyzing fear of missing out on a cryptocurrency that could change your life. The message is always the same. You have to be smarter, faster, and more clever than everyone else. It's a game of picking winners and avoiding losers, a high-stakes chess match where one wrong move means ruin. This complexity creates a paradox. The more information we get, the less confident we feel. We're told to diversify, but also to concentrate, to be aggressive, but also to be cautious. It's exhausting, and it's designed to make you feel like you need an expert to navigate the maze. In this video, we're going to silence that noise. We will dismantle the myth that investing has to be complicated. We are going to explore the profound, almost philosophical power of simplicity. Together, we'll uncover a strategy so straightforward, yet so effective, that it has consistently outperformed the vast majority of financial professionals for decades. We're not just talking about a portfolio, we're talking about a mindset shift that frees you from the daily anxiety of the market. We're going to build piece by piece the only 3 funds you will ever need. To do that, we first have to understand the elegant lie at the heart of the entire financial industry. Most people believe that investing is an active sport. The myth sold to us on a daily basis is that wealth is built through brilliant, tactical moves. It's the story of the Wall Street genius who foresees a market crash, or the savvy stock picker who identifies the next Amazon in a garage. We see it in movies, we hear it from talking heads on TV, and we internalize it. The evidence for this approach seems to be everywhere. Tickers flashing green, headlines celebrating a company's record earnings, charts that go up and to the right. The implicit promise is that if you just do enough research, if you're smart enough, you can catch that lightning in a bottle too. This is the bedrock of the multi-trillion-dollar active management industry. But if this story were true, if genius and hard work were the keys to beating the market, then why do decades of independent studies show that over 90% of professional fund managers fail to outperform a simple unmanaged market index over the long run? That isn't just a crack in the foundation of the myth, it's a seismic fault line that runs directly beneath it. To understand why, we need to look at investing through a different lens. Not as a game to be won, but as a system to be harnessed. Let's use the simple, powerful framework of passive index investing, a philosophy championed by the late John C. Bogle, founder of Vanguard. He argued that instead of trying to find the single needle in the haystack, you should just buy the entire haystack. An index fund does exactly that. It's a basket that holds tiny pieces of hundreds or even thousands of the market's biggest companies. When you buy a share of a total stock market index fund, you're not betting on Apple to beat Google or on Ford to beat Toyota. You are making a single, profound bet on the long-term growth of the entire economy, on human ingenuity, progress, and the enduring drive for innovation. Suddenly, the game changes. You are no longer playing against every other investor in a zero-sum battle. Instead, you're aligning yourself with the unstoppable forward momentum of capitalism itself. What seems like a passive, even lazy strategy is revealed to be the most rational one. The first aha moment is this. Your greatest advantage as an investor is not your intellect, but your humility. The wisdom to admit you can predict the future and to simply own a piece of all of it. If everything we've just said is true, it forces us to confront the most glaring contradiction in finance. If the vast majority of highly paid experts, with their supercomputers and armies of analysts, can't beat a simple, automated index fund, then what exactly are their clients paying for? This is the great twist in the story. You are paying for the illusion of control. You are paying for activity. You are paying for someone to make you feel like something is being done. And the cost of this financial theater is devastating. The single greatest destroyer of long-term wealth isn't market crashes, it's fees. An actively managed fund might charge a 1 or 2% fee per year. It sounds trivial. But the dark magic of compounding works in reverse too. A 2% annual fee on your investments doesn't just reduce your returns by 2%. Over a 30 or 40-year investing lifetime, it can consume over half of your potential nest egg. It is a slow, silent drain that goes unnoticed year after year until it's too late. So, if we now know that trying to beat the market is a statistical trap, and that the fees charged for trying are a guaranteed path to mediocrity, what are we really fighting against? To answer that, we have to look past the charts and into the mirror. The system is designed to exploit our most basic human emotions, fear and greed. When the market is soaring, we feel the irresistible pull of greed, the fear of missing out, compelling us to buy in at the absolute peak of the hype. When the market inevitably corrects, primal fear takes over. We see our life savings dwindling, and our instinct screams at us to sell, to stop the bleeding, locking in our losses at the very bottom. This cycle of buying high and selling low is the investor's original sin. A simple, automated, three-fund portfolio is more than a financial strategy. It's a psychological fortress. It's a pre-commitment to a rational plan, designed to protect you from your worst enemy, yourself. It is the modern investor's version of Ulysses tying himself to the mast to resist the siren S call, the sirens in this case being the daily chatter of the financial news machine. But I know what you're thinking. What about the exceptions? What about the friend who bought Tesla stock in 2013? What about the fortunes made in cryptocurrency? Those stories feel real. They feel like proof that it is possible to beat the system. That heroic act of picking the one perfect investment seems to refute everything we've said. This is the final and most seductive illusion, confusing speculation with investing. Buying a single stock or a new digital coin isn't investing. It's a highly concentrated bet. It's a lottery ticket. The truth is, we suffer from survivorship bias. We hear the one story of the person who won big, but we never hear the stories of the thousands who bet on the wrong company, the wrong technology, or the wrong coin and lost everything. The appearance of genius is often just the reality of luck. Even the greatest act of stock-picking virtue is, for most people, an abdication of a sound process in favor of a gamble. Even its success is a testament to the power of randomness, not a repeatable strategy. So let's assemble the complete mosaic. The pursuit of beating the market is a statistical trap. The fees charged for the attempt are a silent killer of wealth. And our own psychology is hardwired to make us the worst pilots of our own financial futures. The breaking point for every investor comes when they realize this. The game is rigged. Not maliciously, but structurally. It's a system that thrives on activity, emotion, and complexity, because that is what generates fees. The only way to win is to refuse to play. Now that we understand the machine we're up against, and the one inside our own heads, what is the elegant, simple, and powerful alternative? What are these three funds, and how do they work together to form a nearly invincible financial engine? The answer changes everything.